Right now, thousands of UK retirees are losing hundreds or even thousands of pounds every year. Not because they're breaking the law, not because they're doing anything wrong on purpose, but because simple banking and pension decisions, made without realizing it, can quietly increase their tax bill or shrink the benefits they're entitled to. Most people think HMRC only cares about one thing: how much you earn from a job. In reality, it's far more specific than that. How your retirement income is structured, which account it sits in, when you withdraw it, and how it's reported can make an enormous difference to what you actually keep. By the end of this video, you'll know the 3 biggest banking and retirement mistakes that quietly cost UK pensioners money every single year, and exactly how to avoid all 3. Let's deal with something head-on. Because if you've seen headlines or heard rumors about HMRC putting a limit on how much you can keep in a current account, I want to be completely clear with you right now. There is no legal limit on how much money you can keep in a UK current account. None. You can have £500 in there or £500,000, and the bank won't stop you, and HMRC won't fine you just for the balance sitting there. That idea simply isn't true, and anyone telling you otherwise is either confused or trying to scare you into clicking something. So why does this myth even exist? Because something real is happening, and the truth is honestly more important to understand than the myth. Here's the real story. Every UK bank and building society is legally required to send HMRC an annual report of the interest paid into every customer's account. It's called a Bank and Building Society Interest Return, and it happens automatically, every year, for every account, without you doing anything. HMRC then runs that data through a system called Connect, a tool that cross-references what your bank says you earned against what you've actually declared on a tax return, if you file one at all. If the numbers don't line up, the system flags it. And under powers in the Finance Act 2008, HMRC can even compel a bank to hand over your account records directly if it needs to check something, without going to a tribunal first. So, it isn't your balance that HMRC is watching. It's the gap between what your money is doing and what you've told them. That's the issue this video is actually about. Not a fake limit, but the real, quiet ways that gap opens up without retirees even realizing it. Everything here is general factual information, not personal tax or financial advice. Your situation is your own, and for anything specific, Money Helper and a regulated advisor are the right people to ask. Let's start with the single biggest one, because it catches more retirees off guard than almost anything else. Taking pension money out in a way that pushes you into a higher tax band, without realizing it until the bill arrives. Here's the foundation you need. The tax-free personal allowance is £12,570 for 2026-27. Above that, the basic rate band runs up to £50,270, taxed at 20%. Go above that, and you're into the 40% higher rate. These thresholds have been frozen since 2022, and are confirmed frozen all the way until April 2031. So as income drifts upward over time, more and more people get pulled across these lines, without their actual spending power changing much at all. Now think about where your retirement income actually comes from. There's the state pension, which for 2026-27 sits at £241.30 a week. That's £12,547.60 a year. Just £23 short of using your entire personal allowance on its own. Then, there might be a personal pension or a SIP on top of that. And here's where the real mistake happens. With a SIP or personal pension, you can normally take up to 25% completely tax-free. That's called the pension commencement lump sum, capped at £268,275 for 2026/2027. But the remaining 75% is taxed as ordinary income in the tax year you actually withdraw it. So if a retiree decides to take a large one-off withdrawal, say to pay for a new car, a kitchen renovation, or to help a grandchild, that entire amount lands in their income for that single tax year, on top of their state pension and anything else they're receiving. Let's make this real. Imagine a retiree whose state pension uses up most of their personal allowance already. If they then take a one-off £15,000 pension withdrawal in a single tax year, instead of spreading it across 2 or 3 years, a meaningful chunk of that $15,000 could get pushed into the 40% higher rate band, purely because of timing, not because they earned more money overall. Spread the exact same $15,000 across 3 tax years instead, and most or all of it might stay inside the 20% basic rate, sometimes saving thousands of pounds in tax, just by changing when the money comes out rather than how much. This is why the order and timing of your withdrawals matters just as much as the total amount. Drawing a smaller amount from a pension each year and topping up spending needs from an ISA, which doesn't count as taxable income at all, is one of the simplest, most effective things a retiree can do to stay in a lower tax band for longer. We'll come back to exactly how that works together in the checklist at the end. This is the section that connects directly back to what we opened with, because this is where the checking account worry actually comes from, and it's worth understanding properly so you're never caught off guard by a letter you weren't expecting. HMRC may get in touch, usually through what's informally called a nudge letter, if the financial activity it can see doesn't match what's been declared. The most common triggers are straightforward: declared income that doesn't match financial activity on record, rental income that hasn't been reported, self-employment income that's been left off a return, investment income that's gone undeclared, or incomplete records when HMRC asks a follow-up question. A nudge letter is not an accusation. It's not a formal investigation. It's HMRC saying, in effect, our data suggests something doesn't quite add up. Please take a look. Most of the time, when retirees receive one, it's about savings interest. Since interest rates rose sharply over the past few years, far more people are now earning more interest than their personal savings allowance covers without realizing it. That allowance is £1,000 a year for basic rate taxpayers and £500 a year for higher rate taxpayers. And once your savings outside an ISA cross that line, the extra interest is taxable, even though nobody actively claims it on your behalf. Now, here's the part that genuinely worries people unnecessarily, so let's clear it up directly. Gifts from family, inheritances you've received, and simply moving money between your own accounts are generally not automatically taxable events. If your daughter transfers you £2,000 for your birthday, or you move savings from one of your own accounts into another, that is not income, and it doesn't need to be declared as such. What does matter is being able to explain it if HMRC ever asks, which is precisely why keeping basic records, like noting down where a larger transfer came from and why, is worth the 5 minutes it takes. It's not because you're hiding anything, it's because I can't quite remember is a much harder conversation to have than simply showing a note or a message confirming what happened. So the honest, accurate version of this mistake isn't watch how much money sits in your account. It's keep your declared income and your actual financial activity roughly in sync. Use the allowances you're entitled to. Keep light touch records of anything unusual. And the entire checking account limit fear simply stops applying to you. This is the mistake almost nobody talks about. And it can be even more costly than a tax bill, because it isn't about paying more. It's about losing access to money you are entitled to receive. The benefit most relevant here is pension credit. It's a genuinely underclaimed benefit. Hundreds of thousands of eligible pensioners across the UK simply never apply for it, often because they assume their savings disqualify them. For 2026/27, pension credit tops up weekly income to a guaranteed minimum of £238 for a single person, or £363.25 for a couple. If your income, including your state pension, sits below that line, pension credit fills the gap. Here's the part that surprises people. There is no upper savings limit for the main part of pension credit, called guarantee credit. The first £10,000 of savings is completely ignored. Above that, for every £500 or part of £500 you have on top, the DWP assumes you're earning £1 a week of income from it, whether you actually are or not. So someone with £20,000 in savings is treated as having an extra £20 a week of income for this calculation, even if that money is sitting in an account paying very little interest. It reduces what you're entitled to, but it very rarely wipes it out completely. Council tax reduction works on a similar linked structure for pensioners. The same £10,000 disregard, the same tariff income rule above it, and if you're receiving the guarantee credit part of pension credit, you may get your council tax covered in full. Now, here's where the real banking mistake comes in, and it's specific to households where one partner has reached state pension age and the other hasn't. What's called a mixed-age couple. If that's your situation, the rules change completely. Instead of pension credit's generous no upper limit approach, you may need to claim universal credit instead, where the rules are far stricter. Savings above £16,000 generally stop you from claiming at all, with no tariff income softening above £6,000. A pensioner couple who assume they'll be treated the same as any other retired household without checking which side of that line they fall on can end up applying for entirely the wrong benefit, or assuming they're not eligible for anything at all, when in fact a different claim entirely would have worked. The mistake, in short, is treating "I'm retired now" as one single set of rules. It isn't. Which benefit applies, how your savings are assessed, and even which government department handles your claim all depend on small details like your exact age, your partner's age, and which account your money happens to sit in. This last one is the simplest mistake on this entire list, and it's purely a mistake of inaction. It costs nothing to fix, takes about 10 minutes, and roughly 2 million eligible couples across the UK still haven't done it. It's called marriage allowance, and it's specifically for married couples and civil partners. Here's how it works. If one partner earns less than the $12,570 personal allowance, which describes a lot of retired couples where one person has only a state pension and the other has a state pension plus a private pension on top, the lower earner can transfer £1,260 of their unused personal allowance directly to their partner, as long as the partner receiving it is a basic rate taxpayer with income between $12,571 and $50,270. That transfer reduces their tax bill by up to £252 every single year, automatically through their tax code. Picture a couple where one partner retired early and lives only on the full new state pension of £12,547.60 a year, just under the personal allowance, with £22.40 of allowance going completely unused. The other partner is still drawing a state pension plus a workplace pension, putting them solidly into basic rate tax territory. That unused allowance can be transferred across, directly cutting the second partner's tax bill by £252 a year, every year, for as long as both stay eligible. And here's where this becomes more than a small ongoing saving. You can backdate a marriage allowance claim, currently all the way back to the 2022-23 tax year. That means a couple who only just found out about it, but who were eligible for all of the last 4 years, could claim a one-off lump sum on top of this year's saving, potentially over £1,000 in a single payment, on top of £252 every year going forward. A few things worth knowing before you apply. It's the lower earner who must make the claim, not the higher earner. Applying the wrong way round simply won't go through. If you're a Scottish taxpayer, the income band for the receiving partner is slightly different, running up to £43,662 rather than £50,270 because of Scotland's separate tax bands. And if either partner was born before 6 April 1935, there's a different, often more generous option called married couples allowance, worth checking instead. Applying is completely free and takes about 10 minutes directly through gov.uk. There's no need to pay a claims company a cut of your own refund to do something HMRC will do for free. This is, in many ways, the perfect closing example for everything in this video. It isn't a loophole, it isn't hidden, it's sitting in plain sight on HMRC's own website, and the only mistake retirees are making is simply never getting around to claiming it. Let's bring everything in this video together into something you can act on this week. First, review your taxable income every year, not just once when you retire. Add up your state pension, any private pension income, and any savings interest outside an ISA, and check where that total actually lands against the £12,570 personal allowance and the £50,270 higher rate threshold. Second, use your ISA allowance where it makes sense. £20,000 a year for 2026-27. Money inside an ISA is invisible to almost every calculation in this video. It doesn't count as taxable income, and for most means-tested benefit calculations, it's treated the same as any other savings, but at least it's never adding to your tax bill. Third, plan pension withdrawals deliberately, rather than taking large lump sums in a single tax year out of convenience. Spreading withdrawals across multiple years can keep more of your money inside the basic rate band instead of tipping into the higher rate. 4. Keep light-touch records of gifts and inheritances, who it came from, roughly when, and why, even though they're generally not taxable. It turns "I can't remember" into a 5-second explanation if HMRC ever asks. 5. Understand your personal allowance and where your total income sits against it every single year, since frozen thresholds mean your position can shift even if your income hasn't changed. 6. Check your eligibility for pension credit specifically, even if you assume your savings rule you out. With no upper savings limit on guarantee credit and only the first £10,000 counted in full, far more people qualify than realize it, and an award of even a few pounds a week can unlock council tax reduction, NHS help, and other support worth thousands more on top. 7. If you're married or in a civil partnership, check marriage allowance today, not someday. It takes 10 minutes, costs nothing, and if you've been eligible for the last 4 years without claiming, there's a backdated lump sum waiting alongside the ongoing £252 a year. None of this is about hiding money or finding a clever workaround. Every figure in this video came directly from HMRC, gov.uk, the DWP's own published benefit rates, Money Helper, the FCA, and the pensions regulator. The mistakes that cost retirees money aren't usually dramatic. They're quiet. A withdrawal taken at the wrong time, a benefit never claimed, a record never kept. Now you know exactly where to look.